Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the corporate world and maybe uncover a few secrets along the way. Today we are looking at Inotiv Incorporated, their annual report for the fiscal year ending the 30th of September 2025. Now, this report is packed with important information about the company's financial health, its struggles, and its strategies. So buckle up because we are about to decode it. First off, let's acknowledge a significant self-assessment by the company's own management. They've stated that their internal processes for financial reporting were not effective as of the 30th of September 2025. They specifically highlight material weaknesses in how information technology general controls were handled and in overall management oversight of internal controls. This is a big deal. It basically means there is a higher chance that mistakes in their accounting could go unnoticed. They are working on fixing this by hiring more people, improving procedures, and training. But it is a process that takes time and we'll be watching to see if they succeed. Now let's dive into the money side of things. The company reports that as of the 30th of September 2025, they were technically in compliance with their loan agreements. This is a small bright spot, however, they immediately warn that if things don't improve rapidly, they are at risk of failing these financial tests in the next 12 months. This is a serious warning sign and directly impacts their ability to operate normally. Looking at their debt situation as of the 30th of September 2025, total debt, before considering issuance costs, was about $411.7 million. This is a substantial amount of money. They have senior term loans, delayed draw term loans, and incremental term loans that are all maturing in the next 12 months. The company openly admits they do not believe their current cash and expected operational cash flow will be enough to cover these upcoming payments if they all come due. This is why they have reclassified a significant portion of this debt as current, meaning it is due within a year. It is a red flag that signals potential financial strain. On the revenue front, things are a bit mixed. For the fiscal year ending the 30th of September 2025, their total revenue increased to $513 million, up from $490.7 million in the previous year. This is a positive trend, showing a 4.3% increase in their discovery and safety assessment segment and a 4.7% increase in their research models and services segment. The company attributes this growth mainly to higher sales of non-human primates and related services in the RMS segment, and an increase in safety assessment services in the DSA segment. While revenue is up, the company is still operating at a loss. Here is where the story gets more complicated. Despite the revenue increase, their operating loss for the year ending the 30th of September 2025 was $30.9 million. This is an improvement compared to the $86.4 million operating loss in the previous year, but it is still a significant loss. The improvement is largely thanks to a big decrease in operating expenses in the RMS segment, partially due to a large charge in the prior year related to a resolution agreement that didn't repeat this year. When we look at the bottom line, the net loss attributable to common shareholders was $68.6 million for fiscal year 2025. This is better than the $108.4 million loss in fiscal year 2024, but it continues to show the company is not yet profitable. Now let's talk about some major risks. A big one is their reliance on importing non-human primates, or NHPs. They are very dependent on suppliers outside the US, particularly in Southeast Asia and Africa. This dependence creates risks related to supply issues, trade factors like tariffs, and legal problems with these suppliers. They even mention that tariffs on imported NHPs have negatively impacted their cash flow. They also point out that their NHP sales have dropped significantly recently, and this trend might continue. This drop is linked to issues with a major supplier and stricter import rules. While NHP prices have come down a bit, they are still a critical and volatile part of their business. Cybersecurity is another major concern. They experienced a significant incident in August 2025 where unauthorized access to their systems was gained, possibly exposing sensitive data. They are still evaluating the full impact, but this type of event can lead to liability, reputational damage, and operational disruptions. They are also facing lawsuits related to this and to past issues. Speaking of legal matters, the company is involved in several lawsuits, including a securities class action and derivative lawsuits. They have reached proposed settlements for both, which, if approved, will cost them around $11 million combined. This legal activity drains resources and creates uncertainty. Going back to those internal control issues, their independent auditors Ernst and Young LLP also issued an adverse opinion on the company's internal control over financial reporting, identifying material weaknesses. This reinforces the earlier concerns about their control environment. They are working to fix these, but it takes time and can be costly. Given all these financial pressures, legal issues, and internal control problems, it is no surprise that the company has stated that substantial doubt exists about their ability to continue as a going concern. This is a very serious statement that means there is significant uncertainty about whether the company will be able to meet its obligations in the near future. They have plans to address this, but the path forward is uncertain. Looking deeper into the segments, the DSA segment showed moderate revenue growth of $7.8 million compared to the previous year. However, their operating income in this segment actually decreased slightly. This suggests their costs are rising faster than their revenue growth in this area. The RMS segment had a much more dramatic turnaround. After a significant operating loss last year, they reported an operating income of $20.6 million this year. This is a substantial improvement driven by increased NHP revenue and significant decreases in operating expenses, largely due to the absence of a large prior year charge related to the resolution agreement and plea agreement. This segment seems to be the primary driver of their recent positive financial movement. A major event impacting their financials was the resolution agreement and plea agreement reached in June 2024 relating to their former canine breeding facility. This agreement involved significant fines and commitments to facility improvements totaling millions of dollars. While this agreement is largely in the past and their specific charge from this impact did not repeat this year, it still represents a substantial financial burden and a difficult chapter in the company's history. So, what is the overall picture for Inotiv Incorporated? On one hand, they are showing some revenue growth and have improved their operating income in one key segment, the RMS segment. They are also making efforts to strengthen their internal controls and manage their debt. However, the company is still losing money, the debt load is very high, and the threat of covenant breaches and potential acceleration of debt payments is very real. The statement about substantial doubt regarding their going concern status is the most concerning aspect. They are heavily reliant on a volatile market for non-human primates and face significant risks from cybersecurity threats and ongoing legal battles. Their ability to execute their site optimization and debt refinancing plans will be absolutely critical to their survival and future success. What is your opinion on Inotiv's situation? Do these numbers signal a potential turnaround or continued struggle? Let me know your thoughts in the comments below. If you found this deep dive helpful, please hit that like button and subscribe for more corporate analysis. Also, consider joining our Discord community linked in the description to continue the conversation. Thanks for watching, and we'll see you in the next episode of Corporate Decoder.